3.7 out of 100. Retail investors are currently experiencing what they believe is the end of the financial world. The data suggests they are simply providing the liquidity for someone else's trade. Right now, the gold miners' bullish percent index, the absolute thermometer for the precious metal sector, has collapsed to 3.7. Mathematically, 96.3% of the entire gold mining sector is in a confirmed structural downtrend. The retail crowd couldn't stomach the volatility, and they have officially capitulated. They are selling their shares at any price, just to make the bleeding stop. But if you think this is a fundamental failure of gold, you are falling for the oldest trap on Wall Street. Welcome to the Phase 1 liquidity flush. This is not a precious metals crash. It is a structural breakdown of derivative market plumbing. In Q1 2026, the CME clearinghouse aggressively hiked margin requirements on futures contracts. At the exact same time, the broader tech and equity markets began to violently sell off. Over-leveraged hedge funds suddenly faced massive margin calls to raise emergency fiat to save their collapsing portfolios. They couldn't sell their illiquid dying tech stocks fast enough. Instead, they were mathematically forced to liquidate their safest, most profitable assets, gold and silver. They aren't selling gold because they want to. They are selling it because the clearinghouse is holding a gun to their head, selling your hardest asset to cover your worst trade. A true masterclass in panic. This mechanical forced selling has created the Divergence Trap. Algorithms are currently pricing paper mining stocks as if the industry is going bankrupt tomorrow. But step away from the paper derivatives and look at the physical vaults. The reality is profoundly different. While retail dumps paper ETFs at a loss, global central banks have quietly hoarded over 2,300 tons in the last 3 years. The drain on silver is even more aggressive, driven by the relentless demand of AI data centers and industrial infrastructure. COMEX registered silver, the actual physical metal available for delivery, has plunged below the critical 100 million ounce threshold. The paper price is crashing, while the physical supply is evaporating. The rubber band connecting paper to physical has never been stretched this far. If you are terrified of holding hard assets right now, you lack historical context. We have seen this exact liquidity vacuum before. In 2008, the dash for cash dragged gold down 33%. In March 2020, it happened again. The retail masses screamed that the safe haven thesis was dead. What happened next? Central banks panicked. The money printers were turned on to inject liquidity, and a violent V-shaped recovery ignited. Gold surged 166% after the 2008 flush. Silver climbed over 400%. A safe haven asset protects you from the permanent bankruptcy of the system, not from temporary algorithmic volatility. So, how does the smart money weaponize a 3.7 capitulation? They don't try to catch a falling knife by dumping their entire portfolio in at once. They deploy dry powder through tranche buying, by systematically allocating capital at predetermined steps downward. They mechanically drag down their average cost basis. When the inevitable central bank pivot occurs and the rubber band snaps back, the institutional allocator is massively profitable, while the retail gambler is still praying to break even. The wealth transfer is actively happening, hiding behind the smoke of margin calls. You are either the one providing the liquidity or the one buying it. Are you holding physical assets, or are you trapped in the paper illusion? Let me know below. Subscribe to Asymmetric Intel for your weekly macro briefing. As always, this is strictly macroeconomic intelligence, not financial advice. See you in the next briefing.